It is 6:14 on a Thursday morning in a quiet neighborhood outside of Columbus, Ohio, and Harold is sitting at his kitchen counter with a printed brokerage statement spread flat under the overhead light. The fluorescent glow catches the edge of his coffee mug and throws a pale rectangle across the page where one number sits circled in blue ink: $438,200. He pulled that statement from the printer last night, but he has been staring at it since before dawn, running the same question through his mind without arriving at an answer. The house is still, the furnace clicks on and off in the basement, and the only other sound is the low hum of a refrigerator he bought the year his youngest left for college. Harold needs $40,000 this year to cover property taxes, a new roof estimate, and the gap between his Social Security check and what it actually costs to live. His hand hovers over a yellow legal pad where he has written two options in capital letters, one underlined twice. He leans back, exhales slowly, and presses his thumb against his temple the way he always does when a decision feels heavier than it should. The problem is not whether he has enough money, he does, but where he pulls it from and what that single choice triggers in places he has never thought to look. That $40,000 withdrawal feels simple, but the consequences reach 2 years into the future and touch accounts Harold does not even associate with his brokerage. This is not a rare situation. Millions of retirees face this exact arithmetic every single year, and most of them make the withdrawal without understanding what it sets in motion. The mechanism has a name. It is called IRMAA, and the majority of people do not hear about it until the surcharge letter arrives in their mailbox. That letter changes everything. It can raise your Medicare premiums by thousands of dollars a year, and the trigger is a single line on your tax return. Here's how the whole sequence works and what you can do before December 31st to keep it from happening to you. Over the next few minutes, you will understand exactly how one withdrawal from a traditional IRA or 401k can push your income past a threshold the Social Security Administration uses to set your Medicare Part B and Part D premiums. You will see the precise dollar amounts where each surcharge tier begins and what each tier costs per month. You will learn why the timing of a withdrawal matters more than the amount, and how a different sequence of moves in the same year can save you tens of thousands of dollars over a 15-year retirement. You will also walk away with a 4-step process you can start this week. You do not need a finance degree to follow this. You need 20 minutes and a willingness to look at your own numbers honestly. Retirement changes the rules in a way that catches most people off guard, because for 30 or 40 years, your financial life had one dominant input, your paycheck, and one dominant output, your expenses, and the tax code handled everything in the background through withholding. If you have recently retired or you are within a year or two of retiring, stop and think about your own accounts for a moment, because what applies to Harold almost certainly applies to you. Once that paycheck disappears, you become the one who decides how much taxable income shows up on your return each year. That is an enormous shift in control, and most retirees do not realize they have it. The IRS still wants its share, but the timing and the source of every dollar you withdraw now determine how large that share is. Think of your retirement accounts as ingredients in a recipe. Each ingredient behaves differently under heat. Some can take high temperature without changing, others burn the moment you expose them. And the order you add them determines whether the final dish comes out balanced or ruined. The heat in this metaphor is your taxable income, and the ingredients are the 3 major types of accounts most retirees hold. Getting the recipe wrong does not just affect 1 year, it compounds across every year of your retirement. The first ingredient is your traditional IRA or traditional 401k, which is the account most retirees have the largest balance in. Every dollar you contributed went in before taxes, which means every dollar you pull out is treated as ordinary income by the IRS, taxed at whatever your marginal rate happens to be that year. If you withdraw $40,000 from a traditional IRA, the IRS sees $40,000 of income, period. There is no discount, no special rate, and no distinction between that money and a paycheck you earned at a desk. These accounts also carry required minimum distributions starting at age 73, which means the IRS eventually forces you to take money out whether you need it or not. The second ingredient is your Roth IRA or Roth 401k, and it works in the opposite direction. You contributed after-tax dollars, so qualified withdrawals come out completely tax-free. They do not appear on your tax return at all. This means a $40,000 withdrawal from a Roth adds 0 to your adjusted gross income, triggers no bracket increase, and does not show up on the radar of any income-based surcharge. The contrast between these two accounts is not a minor detail. It is the hinge that the entire strategy turns on. The third ingredient is a taxable brokerage account, where gains are taxed as capital gains rather than ordinary income. Long-term capital gains rates are lower than ordinary income rates for most retirees, often 15% or even 0%, depending on your total income. This account gives you flexibility, but it carries its own seasoning. The proportion of gain versus basis in each position determines how much taxable income a sale actually generates. Understanding all three ingredients is what makes the recipe work, so keep them in mind as we move into the real cost of getting the order wrong. The majority of retirees follow a pattern that feels perfectly logical. They need money, they look at their largest account, and they withdraw from the traditional IRA because that is where the balance is. The reasoning is simple. Why touch a smaller account when the big one is right there? That intuition makes sense on the surface, and nobody would fault you for thinking that way. Here is the first consequence most people never see coming. If your Social Security benefit is $28,000 a year and you withdraw $40,000 from a traditional IRA, your combined income for IRMAA purposes lands around $68,000, and that is before any other income sources. For a single filer in 2024, the 12% federal tax bracket covers income up to roughly $44,000 in taxable income, and the 22% bracket begins immediately above that line. That 10 percentage point jump means every dollar past the boundary costs you nearly twice as much in federal tax. But the bracket jump is only the first domino, because that same income figure feeds into a second calculation you probably have never heard of. The second consequence is Medicare's income-related monthly adjustment amount, known as IRMAA. Medicare uses your modified adjusted gross income from 2 years prior to set your Part B and Part D premiums, which means a withdrawal you make in 2024 affects what you pay in 2026. For a single filer whose income crosses the first IRMAA threshold, currently around $103,000, the standard Part B premium of roughly $174.70 per month jumps to over $244 per month. Cross a higher tier, and you could be paying over $400 per month, which adds up to nearly $5,000 a year in extra premiums alone. That surcharge is not a one-time event. It recalculates every year based on your income, so a pattern of large withdrawals locks you into elevated premiums indefinitely. The third consequence involves how your Social Security benefit itself gets taxed. If your combined income, which the IRS defines as adjusted gross income plus non-taxable interest, plus half of your Social Security benefit, exceeds $44,000 for a married couple filing jointly, up to 85% of your Social Security becomes subject to federal income tax. That means a withdrawal designed to cover a $40,000 expense can cause an additional $23,000 or more of your Social Security to become taxable. Run the numbers on your own situation right now, and you will likely discover that this cascading effect has already started shaping your tax bill in ways you never intended. The cascading is what makes this so dangerous. One withdrawal raises your income, which taxes more of your Social Security, which raises your income further, which pushes your IRMAA calculation higher. Harold's $40,000 withdrawal from his traditional IRA did all three of those things in the same tax year. His combined income crossed the first IRMAA tier, 85% of his Social Security became taxable, and his marginal rate jumped from the 12% bracket into the 22% bracket. The roof got fixed, but the true cost was far higher than the contractor's invoice. The dominoes keep falling. And most retirees never trace them back to the single withdrawal that tipped the first one. The real damage is not what happens in 1 year, but what compounds over 15 or 20 years of retirement when the same pattern repeats every January. If the IRMAA surcharge cost you an extra $840 per year, and higher Social Security taxation adds another $2,600 in federal taxes, and your bracket bump costs another $3,100, that single withdrawal pattern drains roughly $6,540 per year more than it needed to. The math over 18 years of retirement puts that cumulative overpayment above $117,000, money that could have stayed invested, growing, and working for your household instead of disappearing into avoidable taxes and premiums. There is a window that most retirees either do not know about or waste entirely, and it sits between the year you retire and the year your required minimum distributions begin at age 73. During those years, if you have stopped working, your taxable income can drop dramatically, sometimes into the 10 or 12% bracket, because your only income may be Social Security and whatever you choose to withdraw. This golden window is the single most valuable stretch in your entire financial life, and the majority of retirees sit in it doing nothing while the lowest tax brackets go completely unfilled. Every dollar of that low bracket space that you leave empty is a dollar you will be forced to fill later at a higher rate when RMDs begin. The counterintuitive move is to use that window to convert money from your traditional IRA into a Roth IRA, paying a small amount of tax now in a low bracket to avoid a much larger tax bill later in a higher bracket. If you are in the 12% bracket and you convert $30,000, you pay roughly $3,600 in federal tax on that conversion. The math tells you that the same $30,000 withdrawn 10 years later, when RMDs push you into the 22 or 24% bracket, would cost you $6,600 to $7,200 in tax, nearly double. Every converted dollar also escapes future RMD calculations entirely, which means it stops contributing to the income figure that triggers IRMAA surcharges and Social Security taxation. Once a dollar moves into the Roth, it grows tax-free and comes out tax-free for the rest of your life. There is no RMD on a Roth IRA during your lifetime, which means you control the timing completely. Conversions done strategically during the golden window reduce the size of your traditional IRA, which shrinks your future RMDs, which lowers your future IRMAA exposure, which keeps more of your Social Security untaxed. Each step feeds the next in a virtuous cycle that is the exact opposite of the cascading penalty Harold experienced. The question you need to ask yourself is whether you have been filling your lowest tax brackets each year or letting that cheap space go completely to waste. Here is the central insight of everything we have covered. The goal is not to pay zero tax. It is to pay the right amount of tax in the right year at the right rate. Retirement planning is not about avoidance. It is about sequencing. That single shift in thinking can save you more than any product, fund, or strategy ever sold on a late-night commercial. Patricia is 64, recently retired from a career in hospital administration outside of Minneapolis. She has $410,000 in a traditional 401k, $38,500 in a Roth IRA, and $67,200 in a taxable brokerage account. Her Social Security benefit is $2,180 per month, which gives her $26,160 per year, and her annual expenses, mortgage, insurance, property taxes, groceries, and travel, run about $58,000. She needs roughly $31,840 beyond Social Security to cover the gap. Patricia does what feels natural. She withdraws the full $31,840 from her traditional 401k in a single transaction in February. Combined with her Social Security, her modified adjusted gross income climbs to a level where about 62% of her Social Security becomes taxable. Her marginal rate sits firmly in the 22% bracket, and her IRMAA calculation 2 years from now will push her into the first surcharge tier. Your situation might be closer to Patricia's than you think, and if you have been pulling from your traditional account first without running the full calculation, you are probably paying the same invisible toll she is. The total extra cost to Patricia in federal taxes and future Medicare surcharges is approximately $4,370 that year alone. Daniel is also 64, recently retired from an engineering firm outside of Charlotte, North Carolina. He has $385,000 in a traditional IRA, $52,400 in a Roth IRA, and $81,600 in a taxable brokerage account. His Social Security is $2,240 per month, $26,880 annually, and his expenses are $57,500 per year, leaving a gap of $30,620. Daniel approaches the recipe differently, adding each ingredient in a measured order based on the temperature it generates. He starts by selling positions in his taxable brokerage account that have a low cost basis, generating $14,000 in proceeds with only $3,800 in actual capital gains, taxed at the long-term rate of 0% because his total income is still low enough. Next, he withdraws $9,620 from his traditional IRA, which brings his ordinary income just to the top of the 12% federal bracket, without crossing into the 22% bracket. He pulls the remaining $7,000 from his Roth IRA, which adds absolutely nothing to his tax return. His total tax bill on the $30,620 gap is approximately $1,150 in federal tax. The difference between Daniel's approach and Patricia's approach is roughly $3,220 in that single year. Daniel then looks at the remaining space in his 12% bracket, roughly $18,000, and converts that amount from his traditional IRA to his Roth IRA, paying about $2,160 in tax. The math on that conversion is straightforward. He pays 12% now on money that would have been taxed at 22% or higher when RMDs force it out a decade later, and every dollar converted permanently reduces his future RMD balance. If you still have room in your bracket this year, this is your window to do the same thing, and that window closes on December 31st, whether you use it or not. That $18,000 conversion saves Daniel an estimated $1,800 in future taxes on that amount alone. Plus, it lowers his future IRMAA exposure for every year the money would have remained in the traditional account. Over 18 years of retirement, the cumulative difference between Patricia's approach and Daniel's approach, accounting for annual tax savings, avoided IRMAA surcharges, reduced Social Security taxation, and the compounding growth of Roth dollars, exceeds $94,000. That is not a theoretical projection. It is the direct result of changing the order of the recipe without changing the total amount withdrawn. One sequence burns, the other preserves. The first thing to do is pull up your most recent Social Security statement and your latest account balances for every retirement account you own, traditional, Roth, and taxable. Write them on a single sheet of paper so you can see the full picture at once. If you have a spouse, include their accounts and their Social Security benefit as well, because IRMAA and tax brackets are calculated at the household level for joint filers. The second step is to map out every source of income you expect this year, including Social Security, any pension, part-time work, rental income, and interest from savings accounts or CDs. Add those up and subtract your annual expenses to find the gap you need to fill from your investment accounts. That gap is the number you are going to fill strategically rather than pulling it all from one place. Knowing your gap precisely is what turns a guess into a plan. The third step is to fill that gap using the sequence Daniel followed. Start with taxable account sales that generate minimal or zero capital gains. Then withdraw from your traditional IRA only up to the top of your current federal tax bracket, and cover any remaining need from your Roth. If there is still room between the top of your traditional withdrawal and the top of your bracket, consider a Roth conversion to fill that space. Before this year ends, you owe it to yourself to sit down with your numbers or with a professional who can verify your bracket position, because once January arrives, the opportunity in this calendar year is gone permanently. The fourth step is to review all of these numbers again in October or November before the calendar year closes, because income can shift. An unexpected dividend, a required estimated tax payment, a capital gains distribution from a mutual fund, a CPA or fee-only financial planner can run the final projection and confirm that your conversion amount stays inside the bracket you targeted. This is not a set-it-and-forget-it recipe. It needs a final taste test before it goes on the table. Harold still sits at that kitchen counter some mornings, but the yellow legal pad looks different now. He learned, the expensive way, that a $40,000 withdrawal is never just $40,000, because the tax code layers consequence on top of consequence in ways that do not show up on the brokerage statement. What he represents is not a cautionary tale about ignorance. It is a reminder that the system was never designed to be intuitive. The information exists, the math is knowable, and the window is open for anyone willing to look at their own numbers with clear eyes. The recipe for a retirement that keeps more of your money is not complicated, but it demands that you add each ingredient in the right order and check the temperature before you turn up the heat. Most people pour everything into the pan at once and wonder why it burns. The difference between those two approaches is not luck or wealth, it is sequence. And sequence is something every single retiree controls. If you are sitting with a gap between your Social Security and your expenses this year, drop a comment with the type of account you have been withdrawing from, traditional, Roth, or brokerage, because the conversation in this comment section has a way of helping everyone think more clearly. And if this changed the way you see your next withdrawal, a like helps other retirees find this before December.